welcome to Sectors Up Close. I'm Elena Casas. Today we're focusing on US small caps, and my guest is Satya Pradhuman, Director of Research at Cirrus. As America recovers from the pandemic, shoppers have been opening their wallets. Despite goods shortages, overbooked airplanes and skyrocketing oil prices driving up the cost of everyday life, consumer spending rose 0.9% last month, according to figures out on Friday from the Commerce Department. That ongoing shopping spree is being driven by a very low unemployment rate and wage increases, especially at the lower end of the spectrum. A survey released last week by the Federal Reserve showed 78% of Americans saying they're doing at least okay financially. But economists are worried that with inflation at 40-year highs and the Fed preparing to hike interest rates by at least half a point in June and July, that confidence may be set to collapse. This is the Russell 2000, an index largely made up of consumer-focused stocks that track the spending habits of the American shopper. It's down 15% so far this year, just slightly below the major cap S&P 500, currently down about 12% for the year. The median market cap here is just under $1 billion, although the largest company here, energy firm Affinitiv, clocks in at $15 billion. The top 10 constituents are a mixed bag, including several energy companies, but also car rental firm Avis and cinema chain and retail trader favourite AMC. So, is the future bright for small caps? To find out, let's ask Satya Pradhuman, Director of Research at Cirrus. Satya, hi, thanks for joining us. We've seen small caps sell off for quite a while now as the money has been moving into larger companies that are seen as a safer bet. Is that going to get worse as the inflation concerns grow?
I think that we've seen quite a bit of damage in the last 12, 18 months. In fact, some of the most significant underperformance has already occurred. Markets have a way of pricing in what's coming. And so to some degree, I think it may have overshot the downside risk of smaller companies. One thing we can flag that's really clear is that as you saw a break of innovation shares in the last year, 18 months, that's only begun recently with the more bellwether technology names or the extended FANG stocks. And so we believe what happens is really smaller companies are kind of like the canary in the coal mine. They have sort of been flagging a severe downdraft for about 18 months. That's already occurred. And so what we suspect is you're still stuck in this earnings-driven market. Another way to think of that is you now have a very skeptical audience. And as a result, earnings. And so as we get through this next reporting season, I do believe the gap of performance that's punished smaller companies, you start to see some sort of stabilization. And on an absolute return basis, I do think you begin to see somewhat of a better outlook over the next 6-12 months, just because we've seen such a dramatic pullback as the market's not only priced in interest rate risk, but really the commodity shocks as a fallout from the Ukraine invasion.
As you say then, if small caps have suffered too much already, will it soon be time for clever investors to get back into these discounted smaller companies?
The market's been wonderful at sort of pricing in oncoming risks. Two, it's unlikely that it's over because clearly the Fed has just begun to siphon liquidity from the system. And so what it really means is focus on earnings visibility. We've used this phrase of barbelled strategy. The idea is to focus on earnings deliverability, visibility. On the other end, whether we like it or not, we believe commodity prices are likely to be higher for longer. So to balance out this defensive bias that we've got, defensive could mean here healthcare. It could mean consumer staples. It could even mean dividend-driven stocks. Those are all working quite well. On the other hand, we are forced to look at industrials, materials, energy. Why? Because in a world as oil prices and commodity prices rise, you typically see a surge in industrial spending. There's a fallout from these higher costs. So we think that you're going to have to run a defensive quality portfolio and at the same time a grittier cyclical type of leadership.
One other trend we've seen in the US small cap space has been certain stocks like AMC Entertainment, or most famously GameStop, becoming hugely trendy with retail traders and seeing huge price swings. Has that swung the wider market?
I think that was a symptom of the last couple of years, right? You had a confluence of things. One is probably the ultimate driver here is the central banks easing out of caution to the pandemic, adding a healthy dose of liquidity. So what it did was it inflated a lot of assets. At the same time, you had a whole bunch of not investors, but bettors that had no parlor gains, and the market was open. And so what we have is a new type of investor, and you've got a massive dose of liquidity that's going to inflate a lot of things: real estate, FANG, et cetera, AMC. And so as we're beginning to reverse course, the thing that's shocking to me is that the average person understands that if central banks are tightening, my house prices may falter. For some reason, it doesn't translate to equities, that if rates fall, stocks go up. And as liquidity starts to come down, inevitably, valuations should be coming down for equity. So take this newfangled investor into AMC and the stocks of the like, and what you've got is an incredible learning curve that they're going to be going through here in the next few quarters.
Just briefly then to finish, what's your key advice to investors in the US small cap space right now in this time of soaringly high inflation and commodity prices?
Yeah, I think that you want best of breed assets. I think that the fear factor is applied foremost to the smaller companies' markets. Have a long-term view, pay attention to the fundamentals, and maybe watch the charts a little less.
Thanks so much for that insight, Satya Pradhuman, Director of Research at Cirrus. Well, before I go, here are some of the stories we're following in this space. The US housing market remains strong for now. Case-Shiller index data out today showed year-on-year growth of 21.2%, beating expectations. But economists polled by Reuters say the housing boom is set to peter out as mortgage rates nearly double. America's airlines cancelled more than 2,500 flights over the Memorial Day weekend. In the latest sign, parts of the economy are struggling to return to normal following the pandemic. Airlines and airports are trying to ramp up staffing to handle expected record demand over the summer. The TSA screened 6.5 million passengers over the holiday weekend. That is still down 10% on 2019, but significantly up on last year. And there was better news for meme stock favourite AMC over the long weekend when Top Gun Maverick, the sequel to the 1986 blockbuster, pulled in $151 million at the US box office. That's the biggest opening weekend of Tom Cruise's career and the biggest Memorial Day weekend for any movie on record, in a sign Americans are ready to come back to the silver screen. And that's your roundup of US small caps. I'm Elena Casas, and this is Reuters.